That single name, 240% plus gains year to date on Nvidia. The commentary on the south side, Evercore, just another run-of-the-mill blowout quarter for Nvidia. Bloomberg Intelligence, Nvidia's third straight double-digit percentage beat of sales consensus this year, and they raised. Torsten, you put out a note in the last week. It wasn't about mega cap tech, it was about small caps. 40% of the companies on the Russell, negative earnings. Torsten, how unusual is that?
That is really unusual. I mean, what the big picture really here is that everything that's going on in the tech world, it doesn't happen in a vacuum. What's very critical about this situation is that we still have the Fed having rates at very high levels at the moment. And that's certainly having a negative impact across the board on companies that have no cash flows. So that's why even the forward PE for Nvidia is, of course, also heavily dependent on whether we will have that slowdown that the Fed is trying to engineer. So I look at this from the broadest perspective of, well, the Fed is still trying to slow the economy down. And with that backdrop, it actually makes more sense to look at the trailing PE. And the trailing PE of the Magnificent Seven is about 50. So that also still leads you to the conclusion that these things are still, in my view, quite heavily overvalued.
Torsten, how challenged are things going to get for the smaller numbers, the smaller names, the smaller companies, given that we just had jobless claims at 209, unemployment south of 4%, we just had a quarter of GDP growth close to 5%, and you've still got 40% of the companies on the Russell with negative earnings?
That is what's so incredible, Jonathan, namely that how can companies not make money if this supposedly is a booming economy? And if I type ECFC Go on my Bloomberg screen and look at what the consensus expects for the next 3 quarters, GDP growth is going to be basically 0.5% for the next 9 months. So with that backdrop, this expectation that everything will still be fine for the next 6-12 months, I think that's completely misguided. The Fed is trying to slow the economy down to get inflation to come down. And with that backdrop, we should expect rates higher for longer. So there's just a missing conversation about rates are actually going to still continue to have a negative impact on companies with high leverage, with low coverage ratios, and with generally weak cash flows. So I still think that high rates are going to have a negative impact on the economy, just like it's had on consumers, on corporates, and on banks. And I think that that process continues.